Jurrien, thank you so much for joining us. We just speaking a little bit about where we are right now as we finish the first half, as we look towards the next half, the rest of 2023. What are your expectations for equities, knowing that we're not exactly sure what the Fed is going to do next as we're sitting in this pause for interest rate policy?
Yes, of course. Good morning. And I just wanted to clarify, I'm not waiting for the other shoe to drop. The market has been waiting for that shoe to drop. And it's obviously it hasn't dropped yet, at least. And so the pain trade has continued to move higher. So the way I think about it, if a bull market has three legs to stand on, or three pillars, right? You have earnings, you have the liquidity environment, the Fed monetary policy, interest rates, and you have sentiment. Clearly, the sentiment pillar has been a very big tailwind because, like I just said, the whole world was waiting for that other shoe to drop, myself included, 6 months ago, because you have that very, very inverted yield curve. And we know what history says when that happens. But the earnings side has really come through much better than expected. Q1 was expected to be pretty bad, and it ended up being pretty good. And of course, starting next week and the week after, we're gonna enter earnings season for the second quarter, and we'll see if that's a repeat of Q1. And then the third pillar is liquidity. And of course, we know that the Fed is not done yet. And the market has been battling the Fed throughout this cycle, saying, you're done and you're going to pivot. And the Fed says, well, not so fast. And so we have obviously the next FOMC meeting coming up in a few weeks as well. And expectations are that the Fed will raise rates. And the expected terminal rate now is at around 5.4. And the Fed is saying, higher for longer. So when you look at those three pillars, the liquidity pillar still isn't in place yet, although the market, I think, would like for it to be. The sentiment pillar clearly is supportive of more gains for the market because nobody was really prepared for this. And then that earnings gain, I think, is going to play the tiebreaker. And so far, it has been better than feared. Let's put it that way.
Sure, without a doubt, better than feared. Forward estimates look like they're kind of flattening out for the S&P 500. We'll see how that does break. But I know you've taken a look, Jurrien, at trying to characterize this market. And up until recently, it seemed like either a very underperforming bull market or the longest and most benign bear market rally we've had forever. Where does that take us from here? We've broadened out a little bit in terms of stock performance. And a lot of the folks I feel are most bullish right now are those who are looking at some of the technical clues of supply and demand for stocks.
Yeah, it's a great question. And this has been a very unusual cycle, right? So the market peaked in January of 2022, so a year and a half ago, almost exactly. It went down for 10 months. The October was presumably the low, but it made an initial low in June. And since that momentum low in June, the market really hasn't gone anywhere if you look at the broader market. Obviously, the cap-weighted S&P has moved up quite a bit because of the leadership of the mega cap growers and the whole AI theme. But if you look at the S&P equal weighted index, it remains in a range where it has been for a year. So, there's an old saying, this is a market of stocks and not a stock market. And it really has been a market of stocks. And what you typically would find after a bear market and in an early cycle bull market is you see a lot of economically sensitive or interest rate sensitive stocks get bombed out at the bottom. You get that big capitulation. Investors, sell everything. And then you get this V-shaped recovery. And we haven't really gotten any of that. And the stocks that are leading on the way up are the stocks that were kind of leading on the way down.